Folks, welcome. Thank you so much for joining us. This is our passive investment for real estate opportunities webinar. We are the Valorous Capital Partners, myself, and I'm going to get into a little bit of who we are here in the near future. But I do want to say thank you so much for taking your evening and spending with us. We're going to try to make sure we get you out of here in 45 minutes to an hour. So we're not going to spend too much of your time, but we want to just have a chance to be able to share a little bit of experience, right? Our experience and what we do at Valorous Capital Partners and who our partners are, like Juliana and Janine and Anne, although Anne's in the middle of a flight right now, but I'll explain that in a minute. But ultimately, we appreciate your spending our time here. So thank you so much. So real quick, before we get into it, right, because obviously the title, right, does tell you passively, how do you make passive investments in real estate? We want to talk about why we love real estate, but there's also a lot going on in the real estate market right now, right? And actually just the markets in general. If you following along the economy, you can see that there's a lot of hesitation, right? A lot of people kind of money on the side waiting for the right time to pounce. Well, my buddy Sean tells me all the time, he's like, Jeff, if you wanted shade, you should have grew a tree 20 years ago. And the best time to grow, if you don't have shade now, the best time to grow a tree starts right now, right? So investing in real estate is one of those things where if you don't invest early enough, you're going to miss it out in the future. So you can never time the market, just like in the stock market, you can never time the market, right? But the good news about real estate is it constantly appreciates. And if you do the right things to it, especially in the multifamily game, add value, which is Juliana will talk about here in a little bit, the property values will always go up, right? That's the beauty about it. And if it's run well, it's got to be run well. If it's not run well, good management team, good operators in the background, that's what happens. So we all know that obviously the in the news, there's a lot of commercial real estate is in dire straits right now. That is for certain select companies, right, that might have got what's called a floating debt rate. It's a little bit economics right now, so I apologize. But for you, if you don't want to hear this, but we'll talk about it here in a little bit too. But ultimately, the market is not in trouble, right? When it comes down to multifamily real estate, it is operators, right, who are getting into loans that were what's called a floating debt, right? So they got a floating debt at 3.5 back in 2020 or 2021, and the property values were high. Money was cheap. They were buying properties really good. Well, once the Fed started hiking the interest rates and getting them up to 5.75 right now, or wherever it is right now, that really boosted the interest rate. So all those floating debt went from 3.5% interest rates on their properties, interest only, up to 8.5%, and they can't cover their debt service ratio. So when they can't cover their debt, properties get foreclosed on, right? So that does happen, right? But the government is trying to do the best they can to make sure it doesn't wipe all those loans out. But there are some loans getting called and some people going foreclosure. So when you're looking at real estate, especially in the multifamily game, understand what the loans are. Where did the loan come from? What is the rate? Is it a fixed rate? Is it a floating rate? Is it a bridge loan? Is there rate caps? Like all these questions you can ask, and we can kind of get into as well too. But we also noticed that a lot of things kind of hinge on the Fed, right? And right now, if you listen to Jerome Powell's speech the other day, the Fed, everyone's kind of asking, when are they going to cut rates, right? Because we should be, at this point, he said we're going to start cutting rates in the middle of the year, right? As we're getting toward the end of the first quarter. When's that going to happen? Well, people are trying to figure that out, and obviously no one has a crystal ball. But ultimately, there's the fact is that they're probably going to delay the rate cut, right? So we're not going to see rate cuts until probably end of 2024, maybe even 2025, right? It's kind of speculative of what's going to happen right now. Now, the reason why they're doing that is because joblessness claims, right, are lower. They're lower than expectations. I think last month it was 201,000 claims versus they projected was 218. So it's less happening. So less layoffs, right? Which means there's more money coming in, as well as wage increases. So wage increases is going up, year over year. It was at 4.5 versus 4.3 in December. So if the Fed is trying to do a balancing act, right, between keeping recessions, from happening and also keeping inflation down, right? So there's a whole bunch of stuff going in there. But that's kind of like my little story. But what does that kind of lead me to is that home prices are still high, right? So people need to find a place to live, and what better place to live than a multifamily apartment complex, right? So that is one of the beautiful parts about multifamily real estate. Now, I'm going to kind of get off my soapbox a little bit on this stuff. If you want to know more, we can talk on a separate line, right? But go ahead and let me know. Shoot me up a question on there. But we talked about the chat earlier. So there is a chat function, right? So Jim's on there. Say, hey Jim, what's going on? Jim, you probably know most people in this meeting. If you don't know Jim, he's a famous guy, and we'll talk about him here in a little bit. But Jim's going to be monitoring the chat as well as any questions and answers. So we got a Q&A function. So if you have a question, pop it in the Q&A and we'll answer it. We got some spots we'll answer it, or Jim will be able to type an answer response if he wants to and answer it right away. And otherwise, if you want to say hi to us, just obviously pop in the chat, right? But we got about 48 people on, so this is excellent. We really appreciate your time. So quick disclaimer, right, is that these strategies that we're mentioning today in this presentation are not appropriate for every single person. Not every investor wants to invest in these opportunities. But if you want to learn more, that's why we're here. Now, we're also not tax consultants. We're not lawyers, right? We're not financial advisors, right? So if you have any specific questions, we're going to talk about some things and some strategies here and how to invest and why to invest and so forth. But again, talk to your CPA, talk to your advisor, or talk to your attorney. And also, future results are not indicative of the past. Is that how they say it, right? So, we are estimating and we're projecting. So you'll see, you heard a lot of terms of us estimating certain things and projecting and so forth. So that's usually what happens in this thing. But again, we have guys like my boy Sharif, who's on the call, right? He was one of our most amazing underwriters who really knows how to really key in these deals. All right, so meet the team. Who are we, right? Valorous Capital Partners. My name is Jeff Urbick. I'll be your host tonight. I've got over 20 years experience in sales and management. I've been actively investing in real estate since 2017. I own a number of single-family rentals, short-term rentals. I do private and hard money lending. I invest in a hard money business, actually. And as well as I'm a general partner and a limited partner on over 500 doors, values over $40 million. Claudio Sanchez is another one of our partners. Same thing. Claudio's been in real estate over 7 years, has run multiple technology businesses, and we are partners on those deals together. Ritesh is our fellow doctor. He's actually in the ER tonight. He's probably listening, but he's not able to join us tonight because he's actually saving some lives. So thank you, Ritesh. We really appreciate you saving lives over there. And then Jim has been in. Jim, you want to do a quick intro of yourself while you're on?
Yeah, sure. Let's go ahead and do it. So, hey, Jeff, I'm excited for you guys to learn from the best here. Let me go ahead and just intro. I got my degrees in organizational and business psychologies, and I've been coaching self-storage and multifamily for quite a while. And over the last 3 years, we've really been tearing up the multifamily space. Excited to have you guys on board with us.
Nice, excellent, Jim. Sorry to put you on the spot there. I know you weren't expecting to talk, but maybe we'll call on you every once in a while to drop some knowledge and drop some love on us, right? And then without ado, we've got our amazing extended team that's on here as well too. So I'm going to pass it over to Janine. So Janine, you can go ahead and introduce yourself.
Okay, so I'm Janine Witten. For those of you that don't know me, I am part of a large female real estate network called RAIN. So shout out to all my RAIN sisters that are here. I'm excited that you joined me on this. I have over 30 years experience in real estate. My husband and I, our first house that we got when we got married had 2 tenants in the bottom of it. So I have short-term properties, Airbnbs, long-term duplexes in 4 different states. And I'm excited about this multifamily and how I'm kind of diversifying my portfolio, being invested in syndications. So thank you all for being here.
Janine, we're so happy you're here with us. And Juliana, you want to go ahead and do a quick little intro as well?
Absolutely. Hi, everyone. My name's Juliana Pino. My background is mainly in fundraising. I've been doing philanthropic events since I was 12. So I sort of extended that now into my professional career. My main background is in operation management. So anything that has to do with streamlining processes, I think that I'm your girl. But aside from that, I do have a passion for, raising capital and connecting with, people every day, all day. So I think that that's where I add my main value to the team. But I'm
Oh,
excited to
excellent.
be here and help answer any questions regarding this amazing property that we have, and yeah, here to be part of the team.
Awesome. Thank you. Thank you. And Anne is not able to join us today. She's actually on a flight right now. So she's up in the sky somewhere. But Anne has a background in corporate law and healthcare. She's been actively and passively investing in real estate since 2001. She operates a single family rental portfolio as well in the US and overseas. She's a GP in over 300 units, 32 million assets under management. She's an LP in over 1,900 doors. I mean, she's got a lot of real estate experience and is a beast. Her commercial multifamily investments are in Texas, Georgia, Arizona, Florida, and Arkansas. And so, yeah, Anne is amazing. So all three of you ladies are amazing, and I'm so happy that we're here having the conversation with you folks, right? So, and now some of you, obviously, people join because you know Janine, or Anne, or Juliana, or maybe myself or Jim, or one of the other partners. But who is Valoris Capital Partners, and why do we all have this cool little logo right here above us, right? So, so we are a private real estate investment firm. So what we do is we specialize in multifamily syndications, right? We're actually going to be specializing in a fund too. So a fund is going to be coming up soon. As Jim mentioned, we also do like self-storage as well too. So it's another asset class that we do love. But we are proven operators, right? So we partner and we have proven operators in our network, right? That we and our team are able to purchase properties, purchase multifamily units, anywhere from 50 to 150 units, and be able to manage and operate those units with our investors, right? And be able to make a great return and then exit those properties and make an even better return, and then keep that money working and compound that money into the next property. So a little more about our track record. So right now we do currently own and operate 4 properties, 37 million under management right now, about 416 doors under management in 4 different states. So our average AAR, which is our annual rate of return, right around 22.7, and our average equity multiple is about 2.03. So with that, our current assets that we currently own right now, we have an apartment in Arkansas and one in Orlando. We've got one in South Carolina. We just closed on one in Jacksonville, Florida, back in which some of you are also partners and investors with that deal as well, back in January. And exciting news, I'm not sure if you all realize this, if you follow us on social, go follow us on social on Valoris Capital Partners. But we just closed yesterday on our 48-unit townhouse facility in Maple Grove, Minnesota, which is just outside of Minneapolis in a Class A environment. So it's awesome. And we got a lot of other opportunities and deals in our thing. Juliana, did you raise your hand by accident? I see you have your
Meant to clap.
Oh, clap. Okay, there you go.
But yes,
are you asking a question? You're supposed to be up here. So that's our portfolio for active, our general partnership portfolio. We also, as investors, we also invest in other people's deals as well too, right? So we are invested in multiple other deals. Quattro Capital, one of our really great partners out of the Emile, which they have a 240 unit. We got EFIS Capital, who have the Creekside Apartments up in Minnesota. We're also partners with them on our Sylvan Townhomes as well too. So we work with a lot of great partners on different opportunities in passive real estate as well too. So I'm going to stop talking because I've been talking enough, right? And I'm going to pass this off to Janine to have her explain why she's so excited about multifamily real estate. Take it away, Janine.
Absolutely, absolutely. I can explain why I'm excited. Again, I've said that I've had single families and long-term rentals, and this is just another way to diversify my portfolio. We're going to talk quickly about each one of these things and why this kind of makes multifamily a really powerful tool to have in your tool belt. So recession, inflation, resiliency, stability, diversification, cash flow, forced depreciation, Juliana will talk about, and then everybody wants to know about tax benefits. How can we keep more of our hard-earned money and give less to Uncle Sam? So we'll start with real estate. as being resilient within the market downturns. Historically, since the 1930s, real estate, it always comes back. So you will historically, again, always make money in real estate. Whereas with stocks and mutual funds that are tied to indexes, we know if you have stocks over the past few years with COVID, you know that they have taken a significant hit. With real estate, they tend to always come back up. So it's a great investment to have. And if you ask 90% of the world's millionaires, they're all invested in real estate. So
Billionaire.
we're doing something right here.
Yes.
As far as with inflation, we all know that the price of food has gone up. Produce is so much more expensive, milk, eggs. If you have money sitting in your checking account, you're essentially losing money because it's probably earning 1%. So if you can get into these multifamily units that are having returns of 18 and 20%, that looks much better. We all know that house prices are rising, and that's forcing people into our rental units. Between the prices of houses going up and then also the interest rates, younger 20s and 30s are having a harder time buying a first-time house, so they're looking to rent more. I personally have 3 20-year-olds, and not only are the prices a deterrent to them, but they want to travel more, and they want to go out to dinner, and they're not really interested in raking the lawn or loading firewood that we made them do when they were younger. So they're happy to rent, which is it's a cultural difference that's happening in our country. So that's another reason why these multifamilies are looking so promising. Hard assets, I said before, there'll always be value in a building and land, where stocks, they can completely crash and go to zero. So if you have, even if the house price dips a little bit, there's still value there, even, with the land itself. And housing, it's a basic need. We have food, water, and shelter. So people are always going to need a place to live. And with these higher prices and the mortgage rates, they're looking to rent, and hopefully they'll go into our apartment buildings. So, okay, so you can diversify. We talk about diversifying our portfolio with stocks and then with real estate. I think the ideal amount that I've seen on Google is 60% in real estate and 25% in the stock market, but you can also diversify within real estate. So if you have a 100-unit apartment complex, there's going to be different socioeconomic tenants that are in there. So if you lose one tenant in a 100-unit apartment complex, you're not going to feel that hit as much as if you had a duplex and a tenant moves out. So personally, I have Airbnbs down in Tennessee, and in the off season, I feel that because they're not renting as consistently as when it's warm and people want to go to the Smoky Mountains. January and February, it's a little bit of a hit. With a 100-unit apartment complex, you're not going to feel that if 1 or 2 tenants have to move out. Then there's geographic diversification. So with multifamily, you can diversify to Florida, you can diversify to California, to Texas, depending on what's going on in our country as far as politics. Right now, we're seeing a mass exodus out of California. It's high. The pricing of houses is high there. The politics, people are not enjoying, and they're moving out at I just looked it up, that 300,000 people moved out in 2022. They're going to Texas and they're going to Florida. And Florida is having I looked this up also on Google, 1,200 people a day are moving into Florida. So those people are going to need places to stay. So if you're invested in California and Florida, then that's going to be offset depending on, where the people are moving. The next type is property type. So within multifamily, there's different asset classes of properties that you can buy, A, B, and C. A being like a luxury apartment that you can immediately get market rents, that's going to cash flow pretty quickly. B's and C's are what we look to buy. It's similar to what our RAIN network teaches, where you buy distressed properties and then you add value. And that's then you're able to increase the rents. So you're going to add value, make these places beautiful for these people to live, and then add value and get cash flow that way. I'll just go on a little side note with that. These B's and C properties, usually we're getting them from they haven't been looked after. So when we can go in there and beautify the properties and make it a nice place for people to live, that feels good in my heart also. So we're not just doing this for, financial gain, but we're also helping our communities. So
I love that, Janine. I think that's a huge part too, right? Is that yes, we invest in real estate obviously to make a return, but the return is the communities, right? The communities that are living in and the residents that live in these communities, making sure they have a safe place to live, making sure they have a nice playground for their kids to play on, right, and feel safe on, and have all that stuff. In fact, quick little side story. I was down in Jacksonville at our property when we closed on it, and I was walking around the property and happened to, be able to talk to a bunch of the community members there. I was playing soccer with some of the kids out in the playground. I mean, it was just amazing. And it made me realize that we're doing it for them as well too, right? To make sure that their property gets better, because the slumlords, so to speak, right, are just they're not in this, they're not in our wheelhouse, right? They're not who we are, right? So being able to beautify a property, make it a great community, and also be able to make a return for investors, it's a win-win in my book.
okay, and then cash flow, that's what we're all hoping for. So cash flow equals the income that the property is bringing in minus the operating expenses, which are the operating expenses. It's self-explanatory. It's the utilities, and whatever all the charges that the building would incur, and then minus the mortgage payment. So we look mainly to our rents for that, but not only that, we're able to add more cash flow by adding other things to the property as well, like vending machines. So we partner with the vending machine companies, and then we're able, they can put their machines on our property, and then we can split the profits. Similar with laundry, we can put washer and dryers in, and then the tenants have the ability to use them right on the property rather than going to a laundromat. So that makes it a desirable apartment building to be at, because who wants to go to a laundromat? We can also charge pet fees in most of our states. I know there are some, like Massachusetts and Tennessee, that you can't charge pet fees, but in a lot of them that you are allowed to, and people love their animals, so they'll be willing to pay an extra $50 a month for having their pet there. Also, if you have a reserved spot or a covered garage, a covered parking spot, if you live where I live in Massachusetts, having a covered spot is huge, because who wants to shovel? Who wants to shovel their car off and scrape their windshield? If you live somewhere like Juliana, she has to worry about the sun and the heat. So I'm sure, you'd like a covered spot to, not get into a boiling hot car. And then there's also storage units or garage spaces that could also add value.
Excellent. Yeah, I love it. I mean, we'll anything to be able to add additional revenue streams, it just boosts our cash flow as well too. So and now I want to pass it over to Juliana, right, to be able to explain what is forced appreciation and why do we love it so much. So take the reins here, Juliana.
Yeah, for sure. Let's see. So basically, forced appreciation, I like the term beautifying the property, making it a good place to live, like we were talking about. I think that's the main purpose and the main goal, aside from obviously making good returns. I think that it's always good to have a deeper sort of meaning behind everything. But so forced appreciation, here you can basically see that multifamily properties are not appraised or sold based on the cap rates, or sorry, they're not based or sold similar to single family homes, where you see the property sold next to you, and you sort of appraise it based on what the one next to it got sold and things like that. With multifamily, it's a bit different. So we have this little formula under here that says NOI equals total income minus operating expense. So this helps us basically like come up with a good sort of strategy to like categorize this forced appreciation. So basically, like Janine was explaining, the total income obviously is everything that we're going to get from your pet fees or your parking garages and things like that. Like all the income, and then minus operating expenses, that's the personnel, everything that, again, she said self-explanatory, which will give us that NOI. But if you see, I think it's in the next slide, we have pretty much everything that will give us that forced appreciation, or in other words, that value add. So with this value add and beautifying the property, I think the best place is always to start with the outside, right? So when you first move in and you have a new property management company come in, you want to see like what they're going to be doing. So we typically start with like the landscaping, making it seem all pretty, maybe gating the community if it's not already gated, fixing up the landscape, the signage, again, just beautifying the property from the outside, and then we work our way inside, right? So we'll renovate the units, make sure that they have all the latest gadgets, if that's what our business strategy is. So in this case, basically, new appliances, new flooring, and then aside from that, the value add for that forced appreciation will typically come from those things that we discussed, like, paying for your garage or paying for pet fees and things like that weren't implemented before with the old management. So by us sort of beautifying the property and making it a better place for everybody to live, we're going to ultimately increase, the rent, and then in turn the property value. So our main goal is to make sure that this is the most amazing, wonderful, place for our tenants to live, and make sure that they're happy. And in turn, we'll also be able to sort of force that appreciation. And again, with that value add of the things that we're adding to the property, be able to sort of exit the property with a completely different number than what we initially bought it for. So obviously with the hope of making sure that, we sort of double or triple what we came in through. So
Excellent. Yeah. I think that's a key point, right? Is in any situation of the property, our goal is to boost the net operating income, right? Which also means that we need to reduce expenses, right? If we can reduce expenses by 5%, right, and we can increase the rents by 5%, right, that's a 10% difference than when we purchased it. And just even boosting it a little bit, right, makes the value of the property increase by not just hundreds of thousands of dollars, but by millions of dollars, right? It's amazing. Sorry, I know you talked about this already, but here's some good opportunities of what we do for value add.
Right, exactly. So I think that, once we start renovating the outside, then the inside, we're able to increase those rents. And once we increase the rents, it automatically increases the property value. So I think there it says, once we update the exteriors, we can add some parks, make it a maybe kid-friendly space. If there isn't already like, a place, we can add barbecues. Sometimes the pools for these properties aren't even functional. So updating that, again, just making sure that everything in the exterior is sort of an enjoyable, nice place. So that's obviously a huge value add for the property. And then, we can ultimately start increasing little by little the rents once we also start renovating the units themselves. So obviously, once it's all painted and pretty on the outside, the units will match the inside, and ultimately that value will just be driven to the roof. So
Nice. Awesome.
yeah, so here you'll also see some additional revenue streams like Janine spoke about. So basically, for instance, the first one, if we buy a property that the utilities are being paid by us, by the property owners, a good way to start adding an additional revenue stream is by billing it back to the tenants. So they essentially will be paying for their utilities and things like that. Again, a great value add opportunity. The laundry facilities, like having a washer or dryer, or sometimes even partnering up with these sort of laundry companies, is always a great revenue stream as well. And pet fees, again, we all love our pets, but we do have to charge pet fees, pet rent. So again, if you're having, let's say 100 units and you're charging $100 a month, or even $50 a month per pet, not including the security deposit for the pet and all those things, you can be making an additional 100,000 a year. So, and the same thing with vending machines, great opportunity, and reserved or covered parking. If there's already, parking, maybe start charging it if, you're not charging that already as an additional revenue stream, super important. And storage units as well. Sometimes, these buildings that we buy have places where we can even place storage units or cubbies or things like that and charge for that as well. So great additional revenue streams that we can add, and we can get creative always and, think of different things that we can add and ways to add more value to the property.
Yeah, excellent. I want to add a little something on the pet fees. So when Claudia and I were walking around our Jacksonville property we closed with our the owner of the property management firm, who this guy owns himself 3,000 units, and then he manages another 3,000 units. So they got like 6,000 units under management total. They've got a little bit of experience, I'll say that much. He has a great way to ensure, because when you're walking around a property or walking around your apartment complex and you step in dog poop, is that fun? No, that's not a good thing to do, right? So in order to stop that, right, or to I guess punish, right, let's say a dog owner, right, who shouldn't be letting their dog poop in the yard, we DNA the dogs, right? So we require that if you want to have a dog living there, we'll DNA the dog. And then if the poop comes, if we see poop, our maintenance person will pick it up, send it, right? And then they'll do a DNA test on it. And the first offense is $300, right? So the second offense, $500, right? And the third offense, I mean, so yeah, you can see if somebody is that forgetful and they let the dog poop on the ground, they're going to have some pretty hefty fines, and then they'll realize that, hey, I should probably clean up my dog's poop, right, to make it a nice, and it helps the community out too. It helps to make a nice area.
To that point, I did live in a building one time that didn't enforce that at all. And right outside of the building was like that little patch of grass where everybody went, and you could not walk into the building without smelling everything. So I know it seems a bit harsh sometimes, but it definitely is a great way to keep the community clean and be able to charge an additional
Exactly.
income.
Yeah.
So.
And we like to put in dog, like, so part of our value add plan, right, is also adding dog pet station to pet waste stations, right? So, at strategic spots right around the property, because properties are pretty big. You can put 4 or 5 pet stations, right, and have the maintenance crew pick up the trash and replace the bags. That way, someone always has a bag. There's no excuse not to pick up your dog's poop. And I guess we talked about dog poop enough, so let's keep going, right? All right, so talk about some tax benefits, right? So this is a very hot topic, right, for a lot of people in the real estate business. I know Janine and I have talked about this a lot. So when we buy a property, and especially in a commercial entity, or actually, let's talk about a regular residential property. If you own a residential property, like a single family rental, usually what we'll do is we'll depreciate that over 27 and a half years, right? That's the number that the government allows us to depreciate that. So we'll take all the cost of all the appliances and all the property values and so forth, and we'll have to spread that out over 27 and a half years and slowly depreciate the property while it appreciates, right? So it's starting to obviously gain some value, but it also allows us to write off a little bit of value. The difference of a commercial real estate, right, like a multifamily place, is that we can deploy what's called a cost segregation study, right? So the cost segregation study goes through the entire property. We hire a firm. There are firms that all they do is cost segregation studies for multifamily properties. We hire a firm. They'll come on site to the property. They'll walk the property. They'll count every single light fixture, every single doorknob. They'll talk about all the value add we did to it. So all the capital expenditure that we've done to the property, even paint, all that kind of stuff. They'll add up all the toilets, how much they cost. So basically what they'll do is they'll take every single piece of asset in that property, except for the land. You can't depreciate the land on the actual in and out of the building. And we are able to then front load that within the first couple of years, right, to be able to offset our taxes, right? So at the end of the fiscal year, our property or our management company will send our investors what's called a K1, right? So that K1 induces a paper loss, right? So if you saw in the news just the other day, I think about a couple of weeks ago, they passed a law where instead of the bonus depreciation going, on a scaling down, I think this year should have been like 60% bonus depreciation, actually maybe even less than, I think it's 40. They increased it back to 100% of bonus depreciation. So what that means is that basically you can almost write off your entire investment in year one, right? It depends on the property, how much CapEx we do and how large it is and all that kind of stuff, right? But if we have the right study, we can then kick back to our investors, proportionate to their investment, a K1 of a paper loss, right? Who doesn't love a paper loss on your taxes? Now, again, we are not tax professionals, so you do need to go to your CPAs and talk about this and how you can take advantage of it, right? Of the bonus depreciation. And it is an amazing way for, like, for example, some of the politicians, right, or some of the large real estate professionals were able to say, hey, I made $1 million last year, but I paid 0 in taxes, right? Is because they're utilizing bonus depreciation to offset their passive gains in real estate, right? And that is the power of it, right? And if you are a real estate professional, I'll give you a little hint. And again, go talk to your CPA. You can also Google this as well too. But if you're considered a real estate professional, you can then write off all of that bonus appreciation against all of your W-2 taxes or your spouse's W-2 taxes, right? Your partner's W-2 taxes, right? So it's a very powerful tool, right? So bonus appreciation and tax benefits are huge when it comes down to multifamily properties. And let's see, we got some time for Q&A. We don't have too much Q&A right now, so I'm going to skip on this one so we can continue going. We're already about 45 minutes in almost. So, Janine, you want to jump in and talk to us about
sure.
what a truly passive investment is?
Yes, and I'll speak quickly so that we can make our time constraint. So multifamily, truly a passive investment. You don't have to do any of the work. I'm an active flipper. I have 3 flips going right now. So I have to be at the properties, check on the GCs. I have to make decisions about design. I also have long-term rentals. And even though the property management company is managing most of it, when something happens, like the roof is leaking, they're calling me to say, hey, what do you want to do? And do you want to get quotes or do you want them to handle it? So this way, all you do is really put your capital up and then sit back and collect the dividends. So it's a hands-off approach. We hire professional management teams that are top-notch, and they handle the leases. They handle every piece of the property management. So again, you don't have to do anything except get that mailbox money. Another wonderful thing is that the liability. If you have a single family residence, if something happens at that property, you're going to be the one that, the lawyers are going to come for. So with a multifamily, your liability is limited, and typically you are not responsible or held accountable for any of the legal issues that might arise. I jumped around a little bit, but the risk exposure, again, that just has to do with non-payment of one tenant is spread across 100 units. It's not that big a deal as opposed to if you have a single family rental. And in the words of Warren Buffett, if you don't find a way to make money while you sleep, you will die working. So I love the fact that we can put our capital in and collect that mailbox money.
Nice. I love that. That's amazing. Look, you quote Warren Buffett. That's great. And who else better to follow than the Godfather himself, right? So
yes.
All right, excellent.
So a little bit about the deal process. Our team honestly is excellent at, being super thorough with looking at the market, trying to find, again, the right property. All of this will come down to the underwriting and then doing the due diligence. If you're not super thorough, you might miss maybe a leak on the roof or something that can be a deal breaker for sure. But, with the team that we have here, I think that we've been doing an excellent job with, again, finding that market, finding the right property, and obviously hiring a professional property management team to make sure that everything's in order and we have all our ducks in a row and that we don't sort of miss any steps with the tenants or with the process, of getting the right tenants in and making sure that everything's streamlined. I think that for the deal process, once we find that deal, underwrite it, get it under contract and do our due diligence, and it's a good deal that we want to move forward with. Our exit strategy again is going to be based on that forced appreciation, and not necessarily waiting for the right market or this or that, but with that forced appreciation, making sure that we bring it up to par of where we want to sell it and at what point. So I think that, with again, the right team and the right people managing it, our deal process is sort of seamless.
Analyzing a few different markets, right, and really becoming experts in that market, and that's what we're doing. We're bullish on Florida. We're bullish on the Midwest, right? Obviously, Texas is a big one as well too, right? So finding that right spot, right, and then Valorous Capital Partners, we're building a really good deal flow right now, machine, right, that's going to come through and be able to evaluate a lot of deals, and we're looking for partners, right, to invest with us, right? So deal sourcing, right, is a big way. It's how you find deals, right? I mean, again, the hardest people, a lot of times people don't like to get into real estate because it's like, well, I don't know how to find a deal. How do I get a deal? Well, there's a lot of different ways to find a deal. You could do obviously from direct. This is a good one actually for wholesalers, right? And people who like to do flipping as well too. Is you do direct to landlord mailers, right? People who are tired landlords, right, and maybe want to get out, whether it's a single family or even a multifamily too. There are mom and pop, right, the old mom and pops, right, that want to retire and don't want to manage property anymore, don't want to deal with the headaches. They've owned it for 15 years. Maybe there's some deferred maintenance in the portfolio, right, and they're just, they don't want to take care of it, right. So those are excellent folks that are looking to get out and be motivated to get out. We also do a lot of our sourcing from brokers, right? So there's, I heard a stat the other day. I was listening to this gentleman talk on his podcast, from, his name is Paul Peoples, from this company called Old Capital. He's been in real estate for over 30 years. And he believes that, there's, let's say there's 100% of the brokerage, right? There's not that many brokers that are listing multifamily properties, right? So of those, let's call it 80 brokers, right? 20 of them are probably the ones who are really making the deals, right? 20% of the brokers are making the deals. The other 80% maybe aren't getting deals or aren't working hard. So being able to build relationships with and discuss and talk about it and build trust with the broker is huge, right? Because they also then provide you on their priority list, right? So they've got their, hey, I know you can close a deal, right? Valorous Capital Partners, here's our deal. Do you like this deal? And then there's also like, okay, if we pass on it, then they're going to be like, oh, well, let's send it to this group, right? So if you can get on that priority list and be a trusted partner for them, and they know that you're going to close a deal, then we get those before anybody else, before they hit the markets, right? And then deal partners. We have a large network within our network. We have even a larger network of folks who are sourcing deals, all right, and they find a deal and they say, hey, I need a sponsor, or I need a KP, I need somebody to help me raise capital, I need somebody to help me manage the property, right? We find a lot of deals through our deal partners, right? And we go through and work with them and make sure they're underwriting it correctly, and then find it from there. And one of the key factors, right, is how do you underwrite and project the returns, right? So for us, it's conservative underwriting, right? So what does conservative underwriting mean? Well, it means, understanding the analysis, the environment, the data, understanding the market itself, right? What are the trends in the market? Where is the rent? Where is the actual rent in the market right now? And we understand all of those different things, from insurance quotes, right, to get the right insurance properties, understand the, if we're developing ourselves in a territory, we're going to be able to understand that, who are our contractors, right? Who are the people that are servicing our buildings, right? What are their quotes going to be if I have a roof that needs to be repaired, right? Having all those understanding and building that network helps us to conservatively underwrite our properties. And then understanding the debt too. So I know that's not on here, but debt financing, right? So how do we get the for the capital stack, right? The underlying debt from the big banks, right? What are those right now? And in fact, actually, right now you can probably get a Fannie Mae loan at anywhere between 5.9 and 6%, right? Which is actually probably better than the commercial, better than the residential world, right? So being able to get a really good fixed rate debt for 5 or 7 years, and interest only as well too, all of those things help out with our underwriting. So we also like to model out different debt strategies, right? So whether we're getting a traditional on institutional level financing, or we're doing a fixed bridge loan, for example, or we're doing a preferred equity stack, to cover some of the expenses. There's a lot of different ways you can model it. So we usually go through 3 or 4 different ways before we find the right one that fits for our project, and what our returns are for our investors. Now, the returns that we're seeing are a little, I wouldn't even say as, these are average, right? Cash on cash, typically around 7 to 9%, right? Throughout the lifespan of the project. The DSCR, which is the debt service coverage ratio, right? Basically, it says like how much can you cover the debt service on your property with the rental income, right? That's our debt service coverage ratio. We always look for right around a 1.4. So 1.0 means that we're not making any money. We're just basically covering our debt service, and that's it. So we look for properties, right, that are averaging out to about 1.4. And it doesn't have to be right in the first year, but again, because we're going to do our value add strategy and build in the rent in that first year, then we can project the right way. And our annual average returns, or annual rate of return, anywhere from, I would say, from 17 to 20 to maybe 22%, right? But again, that's even high. I would say that, conservatively, these days we're looking really good at 18%, right? Is a good return. Equity multiples anywhere from 1.7 to 1.9 ish, right? We're seeing right now in the market. 2 would be great. But again, also, I want to caution you as well too. If you're seeing investors out there, or if you're seeing sponsors or multifamily syndicators out there saying, "Hey, we can give you 10% guaranteed cash on cash. We can give you 2.5% return on your equity. 24, 25, 26% returns." Caution that, right? Ask the right questions, right? Look into their financing, look into their underwriting, and ask the questions. And if you don't know what question to ask, go on to Facebook. There's a tons of multifamily forums, right, that you can ask these types of questions. Or, hey, you can always reach out to us over here at Valorous Capital Partners.
Hey, Jeff, you're on a roll and you're rocking and rolling, but we're coming up close to our end time. But I've got a couple of questions.
Okay, go for
could
it.
we take 2 quick questions? First one, I think he mostly covered, how does the site selection process managed? How is it managed? And then the other one is, I believe a couple of people were asking if you could explain the COC, or the cash on cash,
Okay,
so
gotcha.
that they can understand that a little more.
Oh yeah, okay. So site selection, I believe, Betty, if you're talking about how do we, analyze a territory or analyze a market in MSA, where we're going to go buy a property. So really, it depends on a number of things, like the economy, the move in, move out trends, the rental increases, where the job, if there's jobs being created in that area. We want to look for, so there's class A, right, which is your downtown big city life, right? And then there's on the outskirts, right, which is your class B, class C areas. So we focus on the class B, class C areas, more class B areas, right, to be able to find an asset that's in that site that is maybe a class C, which means it's not, right, the best well kept, and that we can perform our value add and bring it up to market to be able to find that. So hopefully that answers your question. But again, yes, we look at all the different market and economic factors when it comes down to picking and choosing a location.
I did want to jump in really quick, Jeff, and say for this specific property, I think that it's so wonderful that it's close to hospitals, to that new stadium. So I do think that there's a lot to offer in terms of that B-class property. And obviously certain ones are going to be better than others, but specifically for the Potts Creek one, I think that it's in an incredible location.
That's right. Yeah. And we look for good locations, good areas. And like, for example, our Sylvan deal is it's a 506C deal, which is for accredited investors only. But that one is in a class A area in Minnesota, and it's like a 98% occupied area. It's beautiful, right? So cash on cash, right? What does that mean? What is that number? So cash on cash is your cash passive return or your mailbox money we talked about earlier, right? What is your annual return going to be on your money, right? So that is like how much cash flow will you get from that investment? So if you invest 100,000, and we project it's going to be 9% annually, right? You're going to be able to get 9% cash on cash return. Now that's different than the annual average return, right? And that is adding into cash flow plus equity. So if you are in a multifamily syndication, you're not just cash flowing, you're also going to have appreciation and equity that you're going to be purchasing shares into a company, right? So that manages the property. So you will get a return when we exit the property. And actually, I'll show you some good projections on that here as well too. I'm not going to bore you with this stuff, right? If you want to go back and look at it, we can send you the slide deck. But this is a pro forma, right, of a property we actually closed back in June that gives you our actual T3 and T12, which is our trailing 3 and trailing 12. I don't want to get too much in the numbers. And then our year 1 through 5 projections and how our effective gross income is going to go up, which is going to make sure our net operating income is going to increase, minus our debt service is going to be able to provide you that cash on cash return. And this is a total of the property, right? So you see the 4.6 and it scales up to about 10.4 in the end of the property, right? So that's the cash on cash return we're talking about. That does not include your equity in there. Now, asset management, I'm going to skim through this really quick. We can get, again, we can talk about it more later, but asset management is actually, I hate to skim through it, right, Jim? But these are one of the most important, probably the most important role of the multifamily process is asset management. So that's why I hate to skim through it, right? Because it's not just an easy undertaking, but what an asset manager does is they actually manage the property. They manage the due diligence of the property. They manage the construction, the capital expenditures of the property. They manage the property manager, right? So it's not an asset manager is not the person who's day to day on site, leasing up the building. They're the ones who are managing them on key metrics, saying, hey, how many lease ups have we done this week, right? What's our increase of rent are we asking for? Are we getting that increase of rent? Do we need to adjust it at all? Are we able to, tackle our deferred maintenance? All these key factors. The asset manager is the one who's in charge of growing the business, right? Implementing the business plan, and it's a big undertaking, and that is part of what we are building out for Valorous Capital Partners. We're having a whole team that we're building out that's going to be that is asset managing our properties, right? So I hate to just skip over that one, but we could probably do a whole nother episode on that guy. Jeanine, you want to explain to us how we can invest, right? Or ways to invest?
So ways to invest, liquid cash, that's kind of self-explanatory. Any of that money that you have sitting in a checking account making 1%, you could leverage that money and put it into a deal and make between, 18 to 20%. Self-directed IRAs, that's how I invest. And I'm in 2 of these apartment deals. I've taken money out of my 401k and put it into a custodian. It's Quest Custodian down in Texas. They have fabulous customer service. Jeff uses Equity Trust, I believe. I know some of our other Rain sisters have Horizon Trust, but it's just basically my 401k money was kind of sitting there stagnant in the stock market, and I took it out and then was able to PML with some of the Rain sisters in deals that they have. And it's, great returns. HELOC, you can get a HELOC, which is a home equity line of credit on your primary residence if you have some equity in that, and leverage the interest rate. So of a HELOC now, I think you can get them for about 7 or 8%. And then again, you can get into one of these apartment complexes at 18 to 20%. So you're making some extra money there. The whole life insurance, that is, it's for those of you that are in Rain, it's basically what Kelton talks about on the infinite banking and being your own banker. I'm pulling up the book from Nelson Nash. This has really been fabulous. If you can see it, that's the one to get on. Oops, where'd it go? On Amazon. It explains how you compound your interest with a whole life insurance policy. So you actually have the policy, the death benefit, but then you can loan your money out to yourself to invest in real estate. So Jeff, I know you do that. So
yeah.
elaborate on my basic understanding of that.
No, and that was beautiful. Exactly. Again, we could probably get into whole nother webinar series on just like self-directed and whole life insurance policies. But yeah, whole life insurance policy is a great way to utilize the cash value of that policy. So you can take a loan off of the cash value while your money that you've invested in your whole life insurance policy grows annually and compounds, right, with the dividends as well as the guaranteed rate of return. So there's a guaranteed interest rate that you earn, plus there's a dividend. So net averages rate about 5 to maybe 6%. So every year your whole life insurance policy will grow automatically, guaranteed by that number. And you can pull the cash value out of that, right? So if it's set up correctly, if it's engineered correctly, if you put 100,000 in, you could pull 90,000 of that right out within the first 30 days and use that to go invest into a property. In fact, that's how I invest in my friend who runs a hard money business. I take my money out of my whole life insurance policy while it's earning 6% there, and I give it to him, and it earns 10% return on my money right there as well too. So again, we could probably get into that for a long period of time. All right, so Juliana, I want to explain more about our portal and how we do invest.
Yeah, so super quick, it's a great platform, cash flow portal. So basically you'll have all the documents there. You'll be able to see everything that's going on with the investment. The offering memorandum will be on there as well, where you can sign your documents. And basically it's a super easy way to, just keep track of the property and make your investment there directly. So I think that honestly, making the process super easy is key, so that it can get a little bit complicated, especially since this is sort of a hands-off, approach for the investors. I think that this is pretty much like the best way. But yeah, it's super simple and easy to use. And again, you'll be able to see everything in terms of the property there. And we will be sending out anyways, monthly newsletters for all of the investors if you choose to partner with us, so that you can, sort of have an update on the property as well, and be able to keep track that way with still having that hands-off approach.
Yeah, excellent. Well, here's during the investment, what happens, right?
Yeah, exactly.
Yeah.
So yeah, basically, we'll be able to give you guys updates on what's going on with the property, and sort of these monthly updates or newsletters will have, how our occupancy is doing, what the updates have been, pretty much like all the information on how the property is doing, so that again, you can sort of have this, hands-off approach and still keep track of your investment. Obviously we'll be able to provide through the cash portal all of the documents that you need. That's where you'll also be receiving your quarterly cash distributions. So again, just being able to keep track of the investment in general until we liquidate the asset and sell.
Excellent. Yep. And then we're going to get into some questions now. I think so before we do that, I'm going to show you a projected return, right? So if you were to invest $100,000 into an investment with a 6 cap rate, and we can get into that as well. So I think one of the questions was asking about what the cap rates are. This based on, again, this is just a generic explanation of it, right? But it kind of shows you what the average cash on cash would be and a preferred return. So every year you can see the cash on cash gets better, right? As we stabilize and value add the property. And then, for your annual cash on cash return, it adds all the numbers up, and then your equity on the sale would increase to 81,000 on top of the cash on cash to make a cumulative return of 126,000 over the entire period that you've held your investment. Add on top of that your return of your capital. So investing in a property in whatever this example is, investing in this example at 100,000 would return you $45,000 for your cash on cash or your cash flow, and then it would return an equity sale about 81,000. So that would be a projected of 226,000. Now again, this is just an example, right? This isn't a specific deal. Now I saw it in there real quick. Someone asked a question as far as, do investors get paid before the partners do? That does happen if the deal has what's called a preferred return. So you can see right here on the bottom, it says 8% preferred return, but a 9% cash on cash. So that means the property will cash flow average over the lifespan 9%. And the first 8% of that goes right to our investors' pockets before the general partnership gets paid. So that's how a preferred return works. And it is cumulative as well too. So until we meet the average cash on cash or average preferred return of 8%, none of that money goes back to the partners. It all goes. And then after we meet that 8% preferred return, then everything is split on the deal. Typically it's 70-30. It could be 80-20. It just depends on how the operators write that deal. Hopefully that explained that portion of it. So we want to say thank you for your time. We appreciate it. And now is some time for questions. And I see I got a whole bunch of questions in the Q&A. So I'm going to get to those real quick. But if you got to jump off, which I know we're reaching just over an hour, I'll try to keep the questions quick. But if you want to schedule a call with any of four of us, you can use your phone. You could go up and you could you could do the QR code with your phone there, right? And you can schedule a meeting to our calendar invites there. And just so you are aware, we do have investments available right now. Would love to talk to you guys and see if you're interested and have more questions or want to talk more about what are specific deals that we might have available for you and if they meet your investor DNA, right? That's what I like to say. If it meets your investor DNA, let's have a conversation. If it doesn't, that's great. Let's have a conversation anyway. All right, so we're going to get some questions here real quick. I'm going to go number one. Arjun, Anju, I'm sorry, said, what is the average cap rate when you purchase an apartment complex and the average cap rate when you sell the apartment complex? That is a loaded question, my friend. Because every market and every sub-market is different, right? So if Texas has a 5.7 cap rate, and that's let's say it's in a Dallas market, Houston market might be a 6.5 cap rate. The cap rates are what we do is we find and work with companies like a CoStar, for example. CoStar is a great company that actually projects and puts together data, market data specifically for how do we determine and value cap rates. And so a cap rate, again, is a capitalization rate. So basically it is the return on your investment and how much you can make off that investment, right? And actually the way cap rates work, it's there's an inverse relation to it, right? So if right now we're in an inflationary periods where cap rates are rising, right? So as a cap rate rises, the higher a cap rate goes, the less the value of the property goes, right? So a higher cap rate, the lower the cost. Right now we're kind of stuck in this weird period, right, where we got to find properties where the owners want to sell it at a lower cap rate where they think it's a higher valuation, but really the cap rate has kind of gone up a little bit. So when a cap rate compresses and that comes down, then the value of the property skyrockets and goes up. So in a lot of our deals, you'll see that we buy it at a specific cap rate. Let's call it maybe it's a 5.7 cap rate, but we're going to project the sale at a 6 or 6.25 cap rate. That means that we're conservatively valuing the property a lot lower at a higher cap rate, when in turn, we know that the CoStar data might say that in 5 years, which again, no one has a crystal ball, right? But in 5 years, that cap rate is actually probably going to be closer to 5.5, which will then add numerous amounts of millions of dollars of equity return to our investors. So that's how we also conservatively underwrite that. But again, to answer your question, Razun, we look at CoStar and they help us find that, and that's my friend Sharif that does that a lot. All right, so the next one is how do you spend less if you're putting money into improvements by the additional fees? I don't know what by the additional fees mean, but how do we spend less for putting money? So when we buy a property, we're going to estimate the value and the sale of we're going to estimate the amount of capital expenditure that we need to put into the property, right? To be able to get market rents. Because when we're buying a property, we don't want to buy a property that's already at the market, right, for the rent, where we can't increase the value of the rent. Our goal is to buy undervalued properties, right, that are that have anywhere from a, maybe $100 to $300 difference in the market rents. So that way, when we put in our capital expenditure projects and we rehab the properties, we can then ask for increased rents, and then that's how we value our property, get our property value higher. So how do we spend less by putting money in the property? Well, I guess you do, right? If you fix up a property, right, with capital expenditures, you're going to spend less on deferred maintenance and maintenance in the future as well too, right? So hopefully that answers that question. Let's see what else. What are the biggest risks for investment? I mean, I can keep talking if you want me to, but Juliana or Janine, you guys want to take what the risks might be? I mean,
No,
yeah?
you're doing great.
Okay. So there are risks in any investment you do. In fact, there's a risk for driving down the street. You can get to an accident that way, or God forbid somebody gets hit by a bus, right, or something like that, right? That happens. There's a risk in everything you do. So yes, there is a risk, but we obviously mitigate those risks as much as possible. And in the PPM, the private placement memorandum that you would sign for an investment like this, that is what we call the Bible. So kind of outlays any risks that you're going to see, and anything from a hurricane to a pandemic, right? To a fire, right? There's a lot of different market turns. There's political risks. I mean, there's a lot of things.
I think I would add, sorry to cut you off, Jeff, in terms of
go for it.
mitigating risk. I think that when you have a good internal team, obviously you can't control, hurricanes or things that are external, but you can definitely mitigate the risk to make sure that like the business plan is implemented properly, that we're taking care of the property of our tenants throughout the process of that rehab. So I do think that in terms of mitigating risks, you can, if you have a good, strong internal team, you can mitigate a lot of the things that can maybe go south or troubleshoot. But yeah, not a hurricane.
Excellent answer. I love it. Yes, mitigating the risk that we can control, right? So, and that's our asset management team. Our asset management and property management team come into play big time for that one, right? So, all right. So next question: how does it work if and when you get your total investment out, right? So, that is, and I think there's another question right below. It says, so when do you invest? You get paid monthly. So to explain, usually we pay on a quarterly basis. So every deal is going to be different. So again, look at the deal specifically and what the projections are for when the capital, or when your first dividend payment or your first passive investment payment will come. Usually they're paid quarterly, right, after the property is stabilized. So let's just say typically in the first year we're stabilizing that property, and so maybe Q3, maybe Q2 or Q3 after we purchase the property could be the first payment. That's usually on average. There are some deals that maybe take a year or a year and a half or so. I'm sure if you've invested any deals in the past, 3 years, maybe you're paying into that deal, or maybe they're doing a capital call. There's a lot of scenarios go there, but again, it all depends on the operator. But I would say we usually target Q3 of the first year to start paying cash flows. And again, we're looking at properties that we want to cash flow. We want to get heavy cash flow properties, right? So that's our goal, is to be able to buy a property with you, the investor, and have that property cash flow within the first year, right? And be able to pay off those cash flows. Let's see. So again, quarterly payments, I answered that one as well. Okay, so here's another one from Melissa. It says, I'm new to passive investing. How would I set this up? I was planning on setting up an SCIRA. Does the money go in or out of the deals, or just to stay in the pool and get reinvested? So in a PML, Janine, is that something in your team? Is that private money or something? P&L?
Sorry, my father's dog is barking, so I had myself on mute. I hope you guys can't hear him.
Oh yeah, no worries. What is the term PML?
Yeah, so private money lender. Yeah, that's
Okay,
what
gotcha.
we use in our network. And yes.
Gotcha. All right. So yeah. So if you're investing your SCIRA in a private money, right? Those are usually like a 6-month term, right? Kind of like a private money or hard money loan, where you will let's say Janine is flipping a house, right? So I'm going to take my 100 grand and my IRA, and I'm going to loan it to Janine as a loan. So she's actually going to be the borrower, and I'm going to be the bank, right, on her property. And usually in that scenario, if it's a private money loan, you should be the first lien position on that deeded property, right? That is very important. And then you should also have a promissory note or a mortgage tied to that deed for that specific property. Now, that again, that's like single family flipping and so forth, right? That's for private money lending. Now, if you're going to use your self-directed IRA to invest into multifamily, into these syndications, your money is then tied up into that investment for the life of that investment, right? So we typically project our investments exit strategies anywhere from 3 to 7 years. So we just typically like to say an average of 5. So 5 years is our exit strategy for most of our properties. So your money will be tied up in that deal for 5 years, and you'll get paid quarterly payments, right, of that cash flow. And then at the end, I think I'm about to answer another question here that I saw too, but at the end, you would get an equity payment, cash return plus your investment return based on the total profitability of that and what the splits were as well too, if there are any preferred returns and 70-30 splits, right? So hopefully that answers your question. But if you invest in multifamily, it is a long-term investment. So it's not a get-rich-quick scheme, right? It is a long-term investment. Think of it as a way to grow and double your money usually within 5 years. We usually focus on those type of investments and those type of returns, and sometimes faster, right, as well too. Universal life is different than whole life. Universal life is typically, I believe, is off of the stock market, and we don't like to use universal life when it comes down to whole life insurance policies. Let's see. So I'm new to real estate investment. What is IAR and AAR? So IIR is internal rate of return, and AAR is average annual return. So if you invest 100,000, and we're going to say our average annual return is 20%, and it's a 5-year investment, so that's a 100% return on your money, right? And so you're looking at 100,000 will be turned into $200,000, right? Internal rate of return is based on the economics of the property itself and how much the property is actually returning on the investment, or how much the property is profitable for the entire property, included all of the fees and all the structures that go towards, and also the payouts for the management team as well too. So it's kind of the total return on the property is what's the internal return, and then the average return on your investment is what the AAR or ARR stands for. Hopefully that answers the question. Again, I'm not a financial analyst, right? But speak to your CPAs as well too. So estimated cash flow on 100,000. I think we already talked about that. So it depends. Everything depends on the deal, right? So if you want to talk specifically about any of the deals we have, schedule a call with one of the 4 of us. Janine, your phone is probably going to be blowing up over the next. Give Janine, when you back from vacation next week or
Yes, next Monday. But
next Monday? All right. So
I always like to talk to my Rain sisters, so they can call me or text me. It's fine.
okay, there you go. I was gonna say, if not, you can also make your calendar start for next Monday as well too. So that
That's
way you
true.
have a chock full of meetings. So schedule a call with one of us, and we can talk about our open investments that we have right now, and also what our future investments will look at as well too. So so again, estimated return on that investment again depends on the deal itself, right? So but our average, I would say, anywhere between 1.7 to 2.1 equity return or equity multiplier, which means you take your investment and you multiply it by 1.7 or 1.8, 1.9, 2.0, and that gives your estimated return on your investment. I think that's it, guys. I think that's all the questions we have, unless I missed something in the chat. Jim, did I miss anything in the chat? Are we still good?
Someone said in the chat about when I had mentioned the 401k and then using it in the self-directed IRA. So that was a 401k from a job that I left. So there were no penalties for me to do that. If you're still working at that job, I think there are fees associated with it. If you and Jeff, you probably know this better than me, but I think
I'm
there's
almost
penalties,
positive.
right?
Yeah. I'm almost positive you cannot take out your current 401k, like your custodian of your active W-2 401k. They typically do not let you take your money out of there and put it into a self-directed IRA. Usually you have to leave the job. And when you leave the job, then that 401k turns into an IRA. and then you can take that IRA and you can create a new one with a self-directed custodian, and then you can transfer your money to there, and then you tell that custodian, hey, I want to take that money, invest it into real estate. And so you kind of, like I said, self-directed. You direct where the investment goes to versus it being in a mutual fund like a 401k.
Yeah, Jeff, I think one more that a couple of people asked. Let's see. They want to know what's in the works. Do we have more deals coming up?
Yes.
No, Maria
Yes.
would like to know that as well. Absolutely. So we're excited about the things on the horizon. Get with Juliana, Ann, or Janine, or Jeff, or myself. We'll keep you guys in the flow of what we've got coming up the pipe. It's pretty exciting because some of them are 506C and we can't really talk about them yet. We're excited to present those to you as soon as they come around.
Yeah, and just to kind of touch on that, there's two different types of deals: 506B and 506C. So the 506C is for accredited investors only. So I know I'm going a little high level here, but let me talk about what an accredited investor is. Accredited investor is somebody who has a net worth of $1 million, not including their residential home, their current home. Or they make 200,000 over the last 3 years, averaged, with their as a single person, or if they're married combined, make over $300,000. If you have that, if you meet any of those check boxes, you are an accredited investor. You would just need to go to your CPA and have them write a letter that you are accredited, and then you can invest in one of our 506C deals. And those deals you'll see on all of our social media. In fact, our Sylvan Townhomes deal is a 506C, so we can talk about that one. Even though we just closed on it, we're still raising for it. So if you're interested and you're an accredited, talk to Janine. If you came from her, talk to Ann or Juliana if you came from her today, or if you came from me, talk to me, right? And we'll have a conversation about that deal. And then a 506B is a deal. So again, 506C, we can advertise, right? And so you'll see all the deals on social media, that people are advertising for accredited investors. Those are 506Cs. 506Bs, we cannot advertise, right? So if you want to learn more about those, this is a good way to learn about multifamily investing, and then schedule a call and we'll talk about what your investment strategies are and if those deals meet for you. You don't have to be an accredited investor to invest in a 506B. You just have to be what's called a sophisticated investor, right? So that just means you've got money that you want to invest, but you don't maybe meet the thresholds for a accredited investor. We just need to have a conversation and talk about it and then see where we can go from there. 128 4-unit in Jacksonville right now, working on acquiring another property, but not yet. Nice. Oh, yeah, Janine, that's you. I was like, I'm reading someone that? Yeah. Definitely have one in Jacksonville too. So if you have a conversation or you want to talk to Janine about that one, reach out to Janine as well. Anything else? Did we miss anything? Guys, you want to have any closing?
I'm reading the chat, and Lynn said that she was able to move money from her 401k in a company that she's still working at with no penalties. So I guess it is doable.
Yeah, it probably all depends on who's managing your 401k, right? So Morgan Stanley will probably only let you do, specific, or Fidelity or one of those might only let you do, whoever manages your 401k for your company might only let you do a certain amount of investments. You could always call them and say, hey, if I have a deal, can you invest? Can I invest with you through here? And see what they say. It doesn't hurt to ask. That's good. Yeah, exactly. Let's see. So thank you, everyone. Let's see. Thank you. Or y'all, as we say in Texas, we say that in Maryland too, Sherry. Let's see. So if I was able, so Lynn says, I was able to move. Okay. Oh yeah, there. I'm just catching up on my messages here. Sorry. Anything else in the chat, guys? Anything else we need to talk about? I think we're good, right? Yeah.
Yeah, I think we're good.
I think that's a wrap. So sorry, folks. I know that the Q&A went a good 20 minutes longer than the presentation. Sorry if we're running a little late here. In fact, I got to go put my kids to bed. My wife's waiting for me to go help out, brush teeth, and read some stories to my daughter and my kids. So thank you, everybody, for joining. We sincerely appreciate it. And we look forward to working and partnering with you on an investment. And thank you so much for your time. Janine, Juliana?
Yes, absolutely.
Thank you guys for joining.
Yes. Thank you for joining, all my Reen sisters, and let's get together and chat and be in touch. Thanks for your support.
Thank you. Awesome.
Thanks, everybody.
All right, bye-bye.